Thanks very much for joining us for episode 11 of InTek Freight and Logistics, the podcast. I'm Kevin Baxter, and I'm joined by my co-host for this edition, InTek CEO, Rick Lagour. On this episode, we check in on the state of the freight market, where it is and where it's going, with a DATIQ expert who knows a thing or two about freight data. He shares some other stories along the way as well. Let's get started. Getting a read on the freight market comes down largely to having the right data and knowing how to analyze this information. Our guest for this episode has a lengthy track record of doing just that, and he joins us to offer his insights on where the market stands about halfway through 2023 and what a few major indices are telling us. Joining us is Dean Croke, the principal analyst with DAT Freight and Analytics DATIQ. Dean, thanks very much for joining us today.
Great to be with you, Kevin and Rick.
So let's first start out with a little bit about you. Tell us about your general background in freight and how you got to where you are.
Yeah, long story. I'll try and make it quick. But my dad had me on a tractor at 5 in outback Australia, and by 9 I was driving his 1418 Mercedes-Benz on the road at night while he'd sleep. So as a young boy, I was introduced to the trucking industry like drinking through a fire hose. Right, when you work on a farm in Australia, it doesn't matter how old you are considered labour and you have to work. I did a lot of miles before I even got to the point of getting a license. But in the total of it all, I've done a couple of million miles as a over-the-road driver in Australia, mostly owned truck fleets, been an owner-operator, managed large trucking fleets, done a lot of logistics work, managing the Case New Holland farm and construction equipment contract in Australia, distributed all that all over the country and managed the supply chain all the way from Racine, Wisconsin, all the way through the ports into Sydney and then on over dimensional trailers all the way around Australia. So it's sort of a broad of experience, mostly operational experience. And up until late 2000, which was when we moved here, I was sort of heavily entrenched in the trucking business. The transition was when I lost a couple of drivers on my watch. They fell asleep at the wheel. They were 100% compliant with their hours of service, fell asleep and died. And that kind of was a life-changing experience, because whenever you have to go to a spouse and children and say your father has died, it's one of those things in a truck operator's life you never want to do, but when you have to do it, it will change you forever. And it still bothers me to this day that it happened on my watch. And it kind of led me down a path of, trying to understand why do drivers fall asleep, because I decided to get out of the industry from a driving and managing perspective then, and ended up running the Australian Trucking Association and speaking at a conference on fatigue in transportation. There was a bunch of global academics there all over the world talking about fatigue science and sleep. And chance meeting with a Harvard professor. He said, would you come to America and run my consulting business? And that was 23 years ago, and we've been here ever since. So since moving here, I've spent most of my time working on the data side of trucking. After studying human physiology at Harvard, I was able to map all of my sleep deprivation, falling asleep at the wheel experiences from being an over-the-road driver to the science of how the body works. So, that led us to build predictive models to predict when a driver would fall asleep at the wheel using ELD data, which might sound crazy, but it's really easy to do when you have a straight stream of data off an ECM coming in nice and clean every minute. So that's been sort of the sum of my time, is really working around data to try and help truck companies and, most importantly, drivers be safer, happier, healthier, more profitable. And that's most of it's been predictive analytics, but a lot of it's been coaching and sleep science education, working with fleets on how to run and design schedules, like biocompatible schedules, how to design driver schedules around their sleep pattern, not when the shipper and receiver want the load delivered. And that will sound crazy to some people, but every driver will say to you, that would be heaven if I could just sleep when I want to, and everything else will fall into place once you do that. Because that's what paper logs allowed you to do. There's a myth that, because you had paper logs, you were always running illegal. That's not the case. All you wanted to do was really sleep when you were tired and drive when you were wide awake. And that's what paper logs allowed you to do. So I spend a lot of time working on data points to help drivers be better. Today at DAT, I spend time looking on the supply and demand side. So helping them be more profitable, be more strategic about where they position their assets, what demand looks like from whether it be steel, lumber, produce, whatever it is they're hauling. I try to give them the big picture, because as you started the interview, using data is like a jigsaw puzzle. There's no one piece that tells you everything about the market, but when you put all the pieces together from all the data points, you get a pretty good picture. So that's what we do at DAT, is we do freight market analytics to help carriers of all sizes, but predominantly owner operators, because they are the most likely to be using the spot market on a consistent basis. And that's, of course, about 70% of DAT's data is in the spot market. The other 30% is in the contract freight market.
So speaking broadly, again, a little bit before we get more specific to this year, I mean, first of all, you talked about the sleep data that you had. Is that something that people were receptive to right away on the carrier side, or has that evolved? And then I guess the same thing with just general use of data.
It's a really good question. It's an insightful question, because I think you know the answer. And the answer is no. Most people could care less. And that's a tragic story in and of itself. Why wouldn't you want to invest in technology to save drivers' lives? And the reality is, in big truckload carriers running on tight margins, they're less likely to invest in drivers that are going to leave in 90 days on average. So it's hard for them to get ahead of the curve. They have a revolving door of drivers coming in and out. It's hard to slow that down and really invest in companies. So generally, the smaller the company, the more successful. And over the 23 years that I've been here, in the time that I've worked with companies in a number of capacities, mostly consulting capacities, there's probably about 20 companies in total that have fully re-engineered their business and adapted sleep science to everything they do. Biocompatible schedules, putting night owls on night shift and morning larks on morning shift, going to their shipper and asking the shipper to change their appointment times to accommodate the driver's sleep pattern. Completely redesigning start times. You want to start if you've got a slip seat operation, you want to start at 4 a.m. and 4 p.m. so that the night shift is always in bed before the sun comes up, right? Because we sleep at night. We get our best sleep at night. Lots of little things like that. Designing sleeper teams. I did a really big job for CR England. We did biocompatible scheduling. We put night owls and morning larks in the sleeper team, because you want opposite sleep patterns running around the clock. Because if you put two night owls in a sleeper team, what have you got? Two people that want to drive at the same time and sleep at the same time. So that would sound to you like, wow, that's completely obvious. But it's hard to do when you have this massive number of people coming in. So I would say to you, there's a very small percentage of companies that really speak about safety, but in a way that's core to their business. And that's mostly, private fleets will probably more adapt to do that. But truckload carriers, I think, really struggled with that. And Kevin, the reality is that about 85% of your claims cost in a trucking company comes from about 10 to 12% of your accidents. And the 10 to 12% are mostly going to be single vehicle lane departures. And because they're a low probability event, people don't really focus on them. And because the claims form in the insurance industry describes what happened, not what caused it. So you got a hit guardrail to the right and a wrecker to the median, right? So a wrecker, you see the tracks into the snow in winter.
Yeah.
Well, both of those trucks drift at 4 degrees from lane center when the driver sleeps, because the crown of the road runs water from the center. And when you stop steering when you're asleep, you just drift at 4 degrees. But in the claims data, it's a hit guardrail for like $1,200 or a wrecker for $800. Mm-hmm. But it doesn't say what caused it. In our world of litigation and legal liability, people are really reluctant to put down on the claims form what really happened, because a plaintiff attorney will take them to the cleaners. So that's the real answer to why most people don't do it. They're afraid of the legal system, which could put them out of business with a punitive case if they can't demonstrate they did everything they could over and above the law to prevent that accident. That's a high bar.
That's super, super fascinating. You've gone a direction that, we were going to talk numbers and, what's going on with the industry on numbers, but this is super fascinating. We can have just a conversation just on this.
Yeah.
And how those studies are done. But anyway, so I appreciate you sharing it.
I just finished 5 regional workshops for a large insurance company, one of the largest in the truckload market. And we met, every regional conference had like 300 motor carriers, mostly, 50 to, 100 truck fleets. And still to this day, no one's ever been to talk to them about sleep education for their drivers, and how do you design schedules, and who's your most at-risk driver? How do you use data to actually get ahead of the curve? And that was just literally in the last 4 months. So here we are in 2023. Sleep science has been around since the late 90s. We're still not doing a really good job, because it's kind of an abstract concept, right? When you think about sleep, because it kind of happens, but for a lot of drivers, it gets harder as you get older. And if you don't do it, what will happen is drivers will just either wear out and leave, or they will have this massive accident. And this is such a common pattern where you've got your best driver, never had an accident, and then suddenly one day the wheels fall off, figuratively speaking, and there's a massive wreck. That's why fleets really struggle with it, because it's hard to grasp. When you get down to the nitty-gritty of it, it really becomes an operational decision, not a safety decision, because ops are worried about drivers being parked on the side of the road sleeping and not running miles.
Right.
So operations will always kill the safety program at the board table, because everyone's, has to meet their numbers target, right? Which is tractor miles per week, safety numbers, all those sorts of things. The reality is, when you train drivers in the science of sleep, which I've done in a lot of companies and looked at the control group and my group, drivers that are taught how to sleep in a trucking environment, which I've figured out how to do, run 10% more miles per tractor week and are 30% less likely to quit. And both of those are really easy to grasp, because it's only 1 or 2 less truck stops that you call into because you're tired. You do more miles in each hour, not more miles per hour. And that's the difference. A well-rested driver can do more miles in each hour. And because you're more rested, you're less likely to blow up when things go wrong and quit.
Right.
Which is what drivers do. We all behave like 2-year-olds when we're sleep deprived, right?
Yeah.
So imagine what a truck driver's like.
Yeah. Right.
Well, I can tell you what it's like, but it's no fun. So, this is a great topic, but a long way from where we wanted to start today on the truckload side.
Because this is so interesting. I have one more piece on this before we go into the market stuff. So you were talking about the companies don't want to invest in the drivers because there's a lot of turnover, but it's sort of a chicken and egg thing, right? Yep. Where they're not making the investments in the drivers because the drivers leave, but the drivers leave because they're not being invested in the same way, right?
Right. Yeah, that's pretty much it. It really is it's a revolving door. It takes a lot of courage and commitment to stop that revolving door, because you just think, drivers are quitting because they're not making enough miles or they're not making enough money. Well, it's a little bit more than that, because you've got to understand, well, why are drivers feeling like that? And it comes down to how they think and feel, because they've got a lot of time behind the windscreen thinking and feeling all sorts of things. And it's hard to get inside the cab and understand that, but data can get you there. All of my programs that were successful, Kevin, always involved the CEO. After a few years, I figured out that if I didn't get the CEO involved, it was never going to go anywhere.
Yeah.
So it was a program of the month, and then it'd just go away. So I just refused to talk to people unless the CEO was involved in the discussion, because I knew, having worked with a couple of CEOs who were almost out of business and uninsurable, that if you didn't get them involved, it would be very, very hard to affect long-term change, because you've got to re-engineer your entire business. And I'll end on this note. One of my first consulting jobs in this country, the cause of their 3 fatalities they'd had in 3 months, because drivers had fallen asleep at the wheel, the root cause wasn't drivers falling asleep. It was 10% of their revenue that was driving their safety model out the back door. Completely wrong customers to have in their business. And when you talk to truck fleets, they will always tell you there are some customers that really push their boundaries, push their limits, whether it be late departure times. They never give them any notice. They're always changing the pickup times. All of those things are factors that you've got to look at, because it's not just a tired driver. The tired driver is a symptom of how you run the business. And so this discussion in and of itself is why you've got to talk to a CEO, because if they blink when you're having this discussion, you may as well just walk out the door, because it'll never go anywhere. And so that's my summation of 23 years of talking to truckload carriers. The majority don't go that far. I don't know why. It just makes no sense. But if you'd have been on my side of the fence and had to go to funerals, it's like an easy decision. I guess it's because they just haven't seen the dark side of this industry, either at all or enough.
Yeah, right.
So let's move on to the numbers, if we could. So we've been talking about studies, and you've been able to identify things on sleep patterns and stuff like that to understand, how to manage safety and fleets. So now jumping to the number side and where rates are on a contractual basis, on a spot basis, we've been seeing a decline for pretty close to about 18 months. What are some of those key items that you're out there looking at when you're analyzing those spot and contract rates that says, hey, I think it's going to go this direction, or it's going to go up, or it's going to go down? What are some of those things?
So, Rick, that's a really good question. A couple of data points I look at are the number of interstate carriers coming and going in the industry. So, as you know, everyone over 10,000 pounds gross weight has to have a DOT authority. We track the number of reactivations and deactivations each month on a long-haul carrier. So I look at interstate carriers. Why do I look at interstate carriers in the database? 83% of them in the last 3 years joined DAT's spot market load board, which will make sense to you because we've had record high spot rates since July 2020 when PPP loans ended and spot rates took off and diesel dropped. That's when we had this massive influx of carriers. 83% joined DAT's load board network. So I know most of them are in the spot market. So what I do is I track the interstate carriers, the comings and goings. At its peak, we were adding about 8,000 to 9,000 net new carriers every month, all the way from July 2020 when PPP loans ended, all the way to about the middle of 2021. It wasn't until October last year that the net of carriers reactivating and coming into the industry and deactivating, the net of those two went negative. So in May, for example, we had about 9,000 carriers come in and 11,500 carriers leave in the long haul sector for a net deficit of 2,300 carriers. So when you look at the net between new and the exits and the entries into the industry, the first point is there's always carriers coming and going, which I was shocked at. So the number of carriers coming and going, I was just amazed at what carriers would be looking at in this market. Why would you be joining in this market? I haven't got a good answer for that one. But what we do know is that since October last year, we've been running at a deficit. So we've lost about 15,500 carriers out of that interstate pool. It's still only about 4% of the total number of carriers. So it's a small number, right? But if most of those are in the spot market and the spot market's only 15% of all loads moved, that change in capacity in the smaller part of the market has a profound impact on spot rates in the spot market, right? So what we've seen, and that's why I track the entries and exits, because as we've bottomed out, it has bottomed out. So the rate of carriers leaving has bottomed out since October. It's been flat, but showing signs of increasing. Because we knew that this market cycle we're in, you mentioned 18 months, I think it was, the current market cycle. The only reason we think this market cycle was going to turn was not a demand trigger, but a supply trigger. So that we didn't see any catalyst in demand on the horizon that would change this market fundamentally, not even produce season that we're in, because it's even 4% year over year down on last year. And last year wasn't a great year. So we're still not seeing any demand signals that would say this market will turn, which means that it's really a supply equation. And what we think is that as those carriers started to leave the industry in higher numbers last October and are still leaving the industry at a decreasing rate, at the same time, spot market rates have bottomed out for the last month. They kind of flattened out in late March, April, and for the last 3 to 4 weeks, they've been going up slightly. Now, normally, they go on a tear from mid-April. I always, the produce season I define as Vidalia onion pack date on the middle of April, all the way through to July 4. That's produce season. Well, over that period, reefer rates normally go up about 29 cents per mile over that single period, and then they fall away. This year, we're forecasting 10 cents a mile, right? Because produce volumes are so low. Last year, they only went up 2 cents a mile over that period. Last year wasn't a great year either. So it looks like whatever rates are still going up, right? It tells me that the relationship between supply and demand is getting closer to equilibrium. The single-family homes we're building is identical to this time in 2019. It's about 300,000 single-family homes fewer than last year. That's about 66,000 fewer truckloads, flatbed truckloads this year versus last year. So it doesn't matter what you look at, there is less truckload volume in the market compared to this time last year. And because we had this record number of new carriers join the industry in that 18-month period from July through to the end of 2021, we're still seeing some of those carriers hang in there. Right. Some are still hanging on, because when I look at the gross profit margin of long-haul carriers, during the pandemic, they were making as much as 90 cents a mile gross profit after fuel and everything, right? It's down to about 6 cents a mile gross profit now with fuel and rates where they are. In 2019, they were losing 2 cents a mile. So we're not at 2019 levels, but we're perilously close. And while ever diesel keeps dropping and spot rates bottom out, that will give them more runway to hang on by the skin of their nails, because a lot of them are a breakdown away from really struggling to survive. So why is that important? Contract rates follow spot by 4 to 6 months. So if we follow the theory that of previous market cycles, that if we're at the bottom of the spot market cycle now, by the fall, when peak shipping should start, and you should see it in your InTek rail data, right? We should see intermodal volume start to pick up in the traditional peak season. We think that's when the market will show some signs of increased demand. And because we've got fewer trucks around, capacity should tighten and contract rates will start to go up in the fall period. That's what it looks like right now. So that's sort of where we're at from a market fundamental perspective. But this has been a really tough time for carriers, because the last 3 freight recessions lasted 17 to 20 months. And we sort of define a freight recession as when rates go negative year over year. And if you look at 2013, 2016, 2019, they all lasted 17 to 20 months before they turned positive year over year. If you follow that example of things not improving until the fall, that will be about the 17 to 20 month time frame of this current cycle. We think we're about 14 months into this one.
Okay.
We think there's another 4 to 5 months to go of fairly tepid market conditions before we see some meaningful change in spot rates. So if you think about fairly mediocre demand and maybe flat to slightly down, and that's what some of the data points are showing, you could see that this is going to be a supply-driven change in the market, because contract rates are still coming down and spot rates are still sort of bottoming out. So that's sort of where we are here at the middle part of June.
So when you do see that increase start to happen, do you see it something that's going to happen quickly or just gradually moving back up rather than not a hard bounce back?
Yeah. This will be a speed bump at best. One of my colleagues at FreightWaves called it a dead cat bounce. Mike Bordendistel, that was a great term. In the financial markets, they call it a dead cat bounce, which is sort of like not even a speed bump. But I think that's what it'll be like. I think you'll see, if EIA's forecast is accurate and diesel keeps dropping the way it is, and we don't see a surge over the summer, that gives carriers more runway to just, sort of hang in there where rates are. They're getting by. So that's why I think it'll be a slow process, because there's no major catalyst. Let's say there was another major geopolitical event that just changed our whole world. That would be something that might force more carriers out of the industry and change our world as we know it. I don't see any of that on the horizon. So that's why I think as diesel keeps dropping, we should start to see carriers be more viable, which tells me that it'll be while ever demand is flat, we're not going to see a meaningful change in the number of carriers in the industry.
So you were going back to 2019 and you made reference to the Intermodal Index that we have. We've been tracking this, and since you and I were working on this a while back, we've since changed it to, we also look at it as a weighted cost per mile. And it's interesting that 2023 against 2019, it is fairly consistent on a per mile basis of about 25 cents. And it's continued to, and in 2019, continued to track down through the end of the year. And it really was tracking down into 2020 until, the huge catalyst that hit in terms of the pandemic. So it looks like, from our perspective and from your perspective as well, it looks like it's going to be a little bit prolonged because there isn't really a catalyst and it's really a supply issue that's out there, and just not enough demand.
Yeah, we are on the spot market, Rick. We are very close to 2019 levels. There's so many parallels we can draw with 2019. We're only, spot rates are probably, if you talk about dry van, about 6 cents per mile higher than 2019. Mm-hmm. But so many of our load posts and load board numbers look a lot like they did in 2019, which, to your point, Kevin, was a slow grind. The entire year was just, there was no peak season. It was just a slow grind as capacity left the industry. It's interesting, capacity was still leaving the industry right up until the pandemic. Into March 2020, the industry had been losing capacity for the latter part of 2018, all the way through 2019 and the first 3 months of 2020. That was a pretty tough period for carriers, but nothing like the whipsaw we've seen since then with the record rates that we've seen. And of course, there's still a sorting out going on. It's hard. Volumes look a lot like 2019. Capacity is a much harder one because there were so many abnormal things going on that you can't say were something that might repeat themselves. PPP loans was one thing. Global demand crashed. Diesel prices dropped to $2.40 a gallon. And then that period of 18 months from July 2020 was arguably the most profitable period in truckload carriers' history since deregulation. We've never seen anything like that. To think that some carriers were making, you would have seen the earnings calls of the large TLs, large truckload carriers. They were talking about record revenue and incomes, like they were just talking about incredible numbers. Small carriers were making money also. And of course, what they did is they, paid down debt, paid off their equipment, sold assets. And what it did during 2022, it allowed them a much longer runway to absorb higher diesel prices. Again, unprecedented, because normally if diesel hit 580, you'd have said, well, most of the carriers are going to leave this industry, right? Well, they didn't. For the first time ever, our good friend at ATBS, Todd Amon, said, we saw carriers just say, we're going to sit the market out. First time he said, I've ever seen it in our 30-year history, carriers just saying, we're going to sit it out because we can afford to. And that fits with what carriers have been telling us. It fits with what happened in 2021 and 2. And there's still a lot of carriers out there now that own their own equipment and can afford to run for, much lower rates than a lot of other carriers who paid a lot more for newer used trucks that were inflated during the pandemic. And of course, a lot of those new entrants were hit with, new entrant insurance, which were, according to our insurance colleagues, up to $30,000 per power unit. So if you're paying $30,000 for insurance, there's 30 cents a mile. If you got finance, there's another 30 cents a mile. Like you got 60 cents a mile there, diesel 60 cents a mile, wages 60 cents a mile. Like before you add in your 14 cents for maintenance and tires and safety, heck, I peg operating costs at about $1.75. But if you're a new entrant, you're probably needing like $2.20 a mile today, all in costs if you're an owner-operator. That's a long way south of where rates are. And so there's a small number of carriers right on the edge that have really higher operating costs because they kind of bought at the wrong time. They bought into the industry at completely the wrong time. But because rates were so high, it didn't really matter until it did.
Right.
And that was the middle of last year.
Are the larger carriers behaving differently than they have in past situations like this as well?
Yeah, it's a very insightful question, Kevin, because they have, and they did something that was very different. Shippers did too. Contract shippers did something we've not seen before. The summary of the carrier behavior was they're much more price disciplined this time around, simply because in the last RFP rate negotiation period in late last year, they were still looking at 25 cents per mile higher operating costs, give or take a few cents, because of the impact of diesel. So even though they could buy diesel at a much lower rate, bulk buying and hedging, their operating costs had increased over that year, mostly because of high fuel prices. So it became, fairly obvious to shippers that the market would turn, and they'd been stung so badly by loss of capacity in 2021 and into early 2022, they were somewhat reluctant to drive the market down. They wanted to lock in capacity. So if carriers were more price disciplined in the last period of RFP negotiations, noting that they are coming down, right? That's normal. What shippers did was something that we'd not seen before in our data. And our data represents about $40 billion in freight spend on the contract side. What we saw was they said, we're not going to put all of our lanes out to bid. Because normally that's what they do. They put their entire RFP out with all their lanes in a spreadsheet and everybody bids on every lane. The reality is about 30% of the lanes are what we call ghost lanes. No freight ever materializes on those lanes, yet people spend time quoting on them. And when you break down the numbers, 80% of the volume moves on 20% of the lanes. So what the shippers did is said, you know what, we're going to lock in capacity on those 20% of the lanes where most of our volume works. We're going to go deep with our incumbents who played nicely with us during the pandemic and stuck with us. We're going to give them more volume in exchange for lower rates. And of course, more volume on lower rates can also mean you can make more money if you've got better lane density. So that wasn't a bad thing for carriers. What shippers did that was different, they said, what we're going to do is not put all of our freight into the routing guide, and we're not going to tender it out. Because if you put a 1 or 2 load a week or 1 or 2 load a month into a routing guide that goes through the waterfall process and falls out the back end, if everybody's rejecting it because they haven't got capacity, the rates don't work, they didn't bid on it, all those sorts of things, the shipper kind of sets themselves up automatically for a tender rejection. And what you end up with in the spot market is a much more expensive rate. So what they did differently is said, we're going to take the 80% of the lanes that have 20% of our volume, and we're going to send them to the spot market direct through our broker network for a more strategic spot market buy, which ultimately means they'll pay less in the spot market. So that was different. We hadn't seen that before. And when we look at our business, we've seen 2 to 3% more volume in the spot market than we did this time last year. When you think about the loads move, because shippers are sending more volume direct to the broker market and less straight through the carrier network. So that were the two things that really changed. Shippers were more strategic. They went deeper with their incumbents because what they knew is that in the fall this year, capacity would be much less. They'd be back to the next market cycle, and they wanted to make sure that their core carriers stuck with them and that they didn't overspend in the spot market unless it was a strategic buy. So what they're doing now is they're engineering in that strategic spot buy, building good freight networks so that when the market turns, they're better positioned than they were in the last couple of years.
Well, what we're seeing now, we saw that also at the quoting season last year, but what we've seen in the last 6 months is we've seen a number of mini bids come out from shippers where they're trying to go ahead and, again, focusing on the lanes that matter to them. And rebidding quite a number of their lanes that make a real difference. Yeah. So we see that in the shipper market. And then we see on the carrier side, we're seeing carriers large and small, or I should say large and medium, because the small guys typically don't go out there. But those carriers are looking for volume in a really bad way right now. And so they're going in frequently and dropping rates, which then are then forcing, or not forcing, but then they're creating more mini bids by shippers because they say, oh, okay, I can see that the market's going down a little bit faster than I thought it was going to go.
Yeah, that's what we're seeing. We look at our active rates and our replacement rates from our TMS systems. We get this data in every night. We get about 50% of our rates come in every night. About 50% are in our network at midnight before the loads are delivered. So it's a fairly good data set from a timing perspective. And what we track, I track the average of all of the rates that are what we call active rates, which are the rates in the routing guides that are used over and over and over. And then I track replacement rates, which are the new rates coming into the routing guides based on an earlier RFP. And active rates in dry van have been coming down at about 1% every 2 weeks, but replacement rates based on earlier RFPs, 9 to 12% down on previous contracts. Rick, they've been doing that for 4 to 6 months now.
Right.
So contract rates are still coming down for sure. And reefer's coming down much quicker. In a bizarre way, flatbed replacement rates based on RFPs are going up, which is it goes against trend. But I think what's happening is if you think about the capacity that's left the industry, flatbed is kind of a little bit of an anomaly because we talked about housing starts being down at the start of the show. Single-family homes and construction on residential properties are down. There's no question it's down because of higher interest rates and supply chain issues and the high cost of lumber last year, etc. But when I looked at the US Census Bureau data on the spending so the total spend in March, or maybe it was April, total spending in April on residential construction was down 12% year over year, but commercial construction, warehouses, infrastructure, up 28% year over year at a record high going back into the previous century. So even though the net of flatbed might be literally flat, there's parts of the flatbed industry that are doing exceptionally well. When it's specialized permit, overdimensional RGNs, all those sorts of things, warehouses, infrastructure projects. There's so much of that going on in the commercial construction space. I suspect that's providing a much needed boost for flatbed carriers who are suffering from lower volume in the residential building space. We think about lumber volumes and roof shingles and plywood and those sorts of things. So capacity looks like it's tightening in flatbed, which is those rates have been flat pretty much all year at about $2.17 a mile, excluding fuel, whereas dry van rates are sitting at about $1.75 a mile today, excluding fuel. Flatbed's been incredibly consistent and a good part of the industry for a lot of drivers who are equipped to handle that kind of freight.
Well, and you mentioned the NRF data too when we were talking before we got started here. So is that telling us anything about goods demand outside of the housing side of things?
Yeah, I think it does. As we're talking about, the resiliency of the American consumer can never be underestimated. We are seeing retail sales are up. These are core retail sales up 0.5% in April. and up, in April, yes, and up about 1.2% year over year. That excludes automobiles, gasoline, and restaurants. So it's just core retail. That's a really interesting data point. And I'll share with you some data we had yesterday come in from Placer AI, which looks at foot traffic data around malls, superstores, grocery stores, restaurants, things like that. Some of it was that they've been mostly positive. They're flat over the last 3 months, some improvements, but they're not getting worse. And what they said was that one of the most recent trends in people going out to buy things was that they were seeing a boost in the increase in visit time. So the people were spending fewer visits, but spending more time at the location, spending more money, which was a good sign. The more important data point, I think, that came from Placer AI was around the number of people going into Lowe's and Home Depot stores at this time of the year, because we've been talking about kind of fairly flat demand in spring. We didn't really see the surge in volume that we would normally see, but it looks like it may be happening, which is a little bit later than usual, a little bit like produce season. And so what they did is they published some data around home improvement traffic volumes in and out of the stores between April and May. So I'll give you some data points. At Home Depot in April, there were 17% fewer visits to their stores in April versus the April last year. In May, that gap was down to 6%. So they're only 6% behind in May at Home Depot. Lowe's, it was 18% fewer visits in April compared to April 2022. In May, that was down to 5.6%. So it looked like, that sector is perking up a bit. It may be that the home improvement, surge that we normally see will still happen. We don't know that yet. But just anecdotally, when I go to Home Depot and Lowe's, they seem to be very, very busy. And the data would certainly support that. So when you look at consumer sales, retail sales, people visiting locations that, and buying things that we have to haul in the intermodal and truckload market, that's showing some really positive signs here in May. Again, it may not be a surge that sort of changes the fundamental demand levels in the industry, but it may be enough to keep the wheels rolling.
Okay. So you've talked a little bit about some of those specifics into, the flatbed and dry van. Overall ATA truck tonnage, is there anything that's happening there that is jumping out at you?
Yeah, we can get to CAS that was out this morning. ATA won't be out till probably next week, but I've got the April data here. It was down 1.7% month over month, down 3.5%. It's, of course, heavily weighted towards the contract tonnage side of the industry. Really good metric. Bob Costello said that the goods portion of the economy is soft. The truckload tonnage index, when I look at it, it hit its lowest levels since September 2021. And it's been dropping for the last couple of months. So that kind of fits with what we're seeing in the broader market. The Michigan State Index truckload tonnage measures the ton miles of 41 freight producing commodities, down 2.7% year over year. So very close to the ATA tonnage index. Both of those indexes are very good reflections of the truckload side of the industry. I track it a lot. CAS was up. It just came out this morning. A good friend, Tim Denoyer, that writes that great report, up 1.9%. I guess this is a little bit of a surprise, up 1.9% month over month, but still down 5.6% year over year. Remember that the CAS index has a little bit of a weighting towards LTL shipments also. And of course, those volumes are down, according to some of the recent earnings calls from the big LTLs. So I think that's why CAS is down 5.6, whereas the other two indices are down closer to 3.5. I think that's how I would take that. But the important point is that of those three indexes put together, which are probably the most reliable ones, volumes are down compared to this time last year, which guys, I'm not sure is a fair way to look at things, because last year was so abnormally high.
Right.
We still had bloated inventories. We were still having imports surge into the country. Imports didn't really slow down until the middle of the year, at least, as far as our data here. So I think year over year comps are a little bit difficult. The more important data point I look at, again, comes back to 2019, because imports that came out on Monday from IHS Markit peg the total TEU volume for May at it's only 20,000 containers more than May 2019. So a lot of similarities to 2019 from a demand perspective, and most carriers will wince when they hear that, because that was a bad year. In particular, this quarter, because you'll remember this was the quarter when we saw record levels of bankruptcies. And some of the really big truckload names in the industry went out the back door.
Right.
It wasn't a good time for carriers. The other data point I watch is auctions. So you use truck auction data. So one of the metrics I watch is the JD Power report that comes out each month by Chris Visser. It's a wonderful report, but if you think about what a carrier is going to do when they leave the industry, one of the places the equipment goes is to the auction houses. And the number of vehicles at auction in April are identical to April 2019. So again, a lot of similarities when you think about what carriers coming and going out of the industry. So that's kind of where we sit. It's not a sobering thought when you think about 2019 from a demand perspective, but it feels like we're kind of sitting at the bottom of the market right now from a rate perspective, especially in the spot market.
Well, and you mentioned the Cass report. They actually have the chart header says closer to a bottom on it when it talks about a few of the numbers that you referenced, the shipments number being down 5.6%, but all the other numbers are down even more significantly than that percentage-wise, the expenditures, line haul, and inferred freight rates as well.
Yeah, Tim's got some wonderful sayings in describing the market. I was at their conference and he was on our show a few weeks ago. And he said it was less peaky than last month, but I think he's right. I think this current index is a really good summation. Full disclosure, we're a data partner with Act Research. We share data with Tim Denoyer. So Tim that writes the Cass report is our long-term forecaster partner. So they're particularly good at long-term forecasting. We do a lot of the short-term rates. So we rely on his expertise substantially. But I think, he's saying that, it's a softer than normal season in April, which is kind of what we've been talking about. But it was up, which is interesting. We could quote some of his stats here. Freight markets continue to work through a down cycle. Past 3 down cycles have ranged 21 to 28 months. Declining retail sales, destocking remain the primarily headwinds. And I think that's a good point because imports are only up 3% month over month on Monday. They're up 16% in April. But again, they're sort of seasonally on track. You know that April volumes, pick up after the post-Chinese New Year sort of lull. May volumes kind of slow down a little bit, and then it's normally an upward trajectory through September. Tim raises a really good point about, higher inventory volumes being headwinds, because what we don't know, and maybe you know, Rick, better than I, but what we don't know is whether shippers will go back to normal seasonal ordering patterns and volume. Because if they've still got inventory hanging over, what do they do with that? And particularly if it's the wrong inventory for the current season. And I think that affects overall truckload volumes to some degree. So that's why he talks about some of those uncertainties. But he does say that the worst of the destock is in the rearview mirror.
Yeah, we've seen with our customer base a lot of the destocking taking place, but it's kind of hit or miss based off of the industry, because some industries they still have too much inventory and they're asking us to find places to park that inventory until they can relieve it, whether through a sale or they expect their fourth quarter to pick up or the holiday season to pick up. But it's really, it depends.
Yeah, I was quickly trying to find a report on Nike had a report out this week, and I can't remember who it was that was writing about it, but they were basically had a lot of inventory of their shoes, and they hadn't done I'm paraphrasing, they hadn't done as good a job as destocking as they'd hoped, and they were looking for other retailers to help move some of that inventory. That was kind of the genesis of the headline. So I think you're spot on. I still, Rick, it's interesting. I still see some of that bifurcation in the freight market that we experienced during the pandemic, where some commodities were booming, others were tanking. Right. And it was really depending on what, we all were buying. And I still see some of that going on now. I still see some sectors booming, other sectors aren't doing so well. I don't know if that's a long-term play or not. There's no question, there are still supply chain shortages in some sectors. We've just had some kitchen renovations done here. Our builders and suppliers are still struggling with labor issues on the manufacturing side, but worse, spare parts, like getting parts for kitchen hinges and things like that, things you would think would just be in abundance, having real trouble trying to get door handles. I can't get my head around why you can't get enough door handles, but apparently, and this is this week. This happened this week to our new kitchen. So I suspect there's a bit of that still going on. I know on my own Class 8 truck, I'm still having trouble with parts. I do all my own maintenance on my own truck, but I still have trouble trying to get, enough, 5-gallon pails of 15W40 oil. There's still a shortage of, I wouldn't say there's a shortage of the actual liquid itself, but the container packaging is different.
Right.
And the people that normally carry high volume don't. I suspect that because people have got higher inventory costs, they are deliberately carrying less inventory is one of the reasons. Right now, the flip side of that is we've got very loose truckload capacity, so we can get stuff moved really quickly.
Right.
And I think maybe that's what's playing on the inventory. I think this is part of it. People are deliberately not having as much inventory as they would normally because it costs more, but they know we've got a lot of truckload capacity to get things moved around the country quickly. I think that's part of what's going on.
I would agree with you, and I think there's a little bit of bouncing, a little bit up, a little bit down as they're trying to get readjusted onto, a normal plane.
Yeah. I was listening to Larry Gross, who is a pretty good expert on the intermodal side. I think he said that on LinkedIn this morning that intermodal volumes year over year or for the last month have been in that 10 to 12% down year over year range. I look at intermodal volumes as a really good indicator of where, the truckload market, because a lot of our shippers use intermodal as well as truckload. Right. Some have a 50-50 split. So intermodal volumes being down kind of fits the broader picture that we're seeing in the truckload market. Some of the carload volumes are probably less encouraging when you look at chemicals that are used in almost every manufacturing process. So yeah, this is interesting times. We still haven't got through the worst of it. I think we're through the worst of it, but we still haven't got through to the end. And we see glimpses of seasonality coming back into the market, but still, our predictions have been mostly right. But our timing has been a little bit off on some of the things. We thought that the market would have picked up this quarter. We would have seen a significant increase in spot rates. Hasn't happened, but it will happen, 3 to 4 months after because of, a myriad of things that are going on that we're finding it hard to reconcile, like inventory levels. The LMI that came out at the start of the month, Logistics Managers Index, hit a new 6-year low. It was the first time in years that it went into contraction territory, mostly because of the transport component of the index was much weaker this time around.
Well, Dean, we could probably go on and on, but I don't want to keep you any longer. So before we go, let our listeners know where they can find more of your work.
Yeah, I write a weekly blog post that's out every Tuesday night. We publish on our DATIQ show that's on 10 a.m. Eastern every Tuesday on YouTube and LinkedIn. I publish all of those reports that we show on the show, all of those charts free at dat.com/market update. They're available on Tuesday evening. You can download the report with all the charts and graphs. If you want anything in particular, just write to us at askiq@dat.com or connect with us on LinkedIn. I'm on LinkedIn. Just send me a DM and we can connect that way if you need some more information.
Dean, thanks so much for joining us today. Appreciate it.
Dean, thank you so much.
Pleasure. Thank you, guys.
Thanks for joining us for InTek Freight and Logistics, the podcast. And thanks again to Dean Croke for taking the time to speak with us. Check out the links in the description to learn more about everything we discussed. Subscribe or follow now to ensure you get our latest episodes as soon as they're available. And you can help us out by rating and reviewing us wherever you listen. If you have questions, email us at podcast@intechlogistics.com and visit intechfreight-logistics.com for more about what we do. For Rick Lagore, I'm Kevin Baxter. We'll talk to you next time.